Chapter 5, Accounting for Merchandising Operations. In the first 4 chapters that we've covered in this course, we talked only about service businesses. Chapter 5, we will introduce merchandising businesses, and we'll first talk about the difference between those two. And there's 2 ways to account for inventory in a merchandising business. One's called the perpetual inventory system business, and one's called the periodic inventory system. We're first going to look at how to record our accounting entries for both buying and selling merchandise inventory under the perpetual system. And at the end, we'll talk about the periodic system. Merchandising businesses buy and sell goods. Another term for goods is inventory. They buy and sell inventory. You can see different examples of retailers. Walmart's a retailer, Amazon's a retailer, Target is a retailer. Retailers sell to the consumer. Wholesalers are businesses that buy from the manufacturers and they sell them to the retailers. Wholesalers can sell to other wholesalers too, so there can be several wholesalers between the manufacturing business and the retailer. And obviously, the more wholesalers there are, the higher the price of the goods, because each wholesaler, as they sell the goods, are going to need to sell it at a price higher than what they paid for it. We're going to look at just transactions between wholesalers and retailers. We're not going to look at transactions to the consumer yet. We'll look at that a few chapters from now. All right, for a merchandising business, their primary source of revenue is going to be called sales or sales revenue. This slide shows how a merchandising business calculates its net income. It's going to take its sales revenue, and that sales revenue account is going to have the same rules of debit and credit as any other revenue account we've talked about in the past. From that, they're going to subtract out the cost of goods sold and calculate their gross profit. Then they'll subtract their operating expenses in order to calculate net income. Cost of goods sold acts like an expense. It's not really called an expense account, it's called a cost of merchandise account, but it acts like an expense account because we're subtracting it from our revenue. Our cost of goods sold account is going to have the rules of debit and credit just like any other expense account. Cost of goods sold is the cost of the merchandise inventory to the merchandiser. Okay, when they bought it from whoever they purchased it from, that's their cost of goods sold. For example, let's say I sell basketballs, and I purchase these basketballs from my supplier, say it's a wholesaler, and each basketball cost me $15. I sell it to my customer for $25. So for every basketball that I sell, my sales revenue will be $25, my cost of goods sold will be $15, and I will have gross profit then of $10 for every basketball I sell. The operating cycle for a merchandising business tends to be a little bit longer than your typical service business. Your merchandising business has to buy its inventory, it has to sell it. If it sells it on account, it converts it to accounts receivable, and ultimately they get payment on that accounts receivable and it gets converted to cash. Service businesses perform the service, the money is owed to them, goes to accounts receivable, they collect that accounts receivable. So the typical merchandising business, again, has this longer operating cycle. Okay, this slide shows the flow of our costs related to our inventory. Inventory is going to be an asset account to a merchandising business, and it's going to have the same rules of debit and credit as any other asset account, increase on the debit, decrease on the credit. But this is going to be our flow of our cost. Our beginning inventory plus the cost of the goods that we've purchased gives us a total amount we have available to sell to our customers. One of 2 things can happen to this inventory. We can either sell it or not sell it. If we sell it, those costs are going to go to cost of goods sold. If we don't sell the merchandise inventory, we are still going to have it, and that cost is going to be in our ending inventory. So again, we take what we start off with, add what we buy, we either sell it or we don't sell it. Two ways a business can keep up with its inventory. One's called a perpetual inventory system, and one's called a periodic inventory system. Our focus is going to be on our perpetual inventory system, but we're also going to talk about the periodic system. When I was in school, we focused on the periodic system, but we also talked about the perpetual system. At that time, technology was not advanced enough for most businesses to operate a perpetual inventory system, so they had to use a periodic. In today's world, because of the decreasing cost in technology, then businesses can afford to have the computer systems in order to maintain that perpetual inventory system. So both of these have been around for a while, but our focus is going to be on the perpetual, but we will also talk about the periodic. Okay, the perpetual inventory system business is going to keep detailed records of their inventory, both the inventory that they're buying and the inventory that they're selling. When they're buying inventory, with barcodes today, they scan the barcode, that gets added into the inventory. When they are selling the merchandise inventory, they're scanning the inventory, the barcode, to calculate the total amount of the sale, but it's also taking it off the inventory. So it's performing two functions there when it's being purchased. So it's easier to keep up with a perpetual inventory system, again, with the increased technology that's available. A perpetual inventory system business is going to record cost of goods sold every time they make a sale. As we'll see later on, a periodic system business will not. The periodic system does not keep detailed records. They calculate cost of goods sold on their income statement when they're preparing that. And that calculation, you remember back to our flow of cost, we take our beginning inventory, add the cost of the merchandise that we've purchased. That gives us the inventory we have available to sell. We count our inventory at the end of the year. We subtract that ending inventory amount, and that calculates then our cost of goods sold. So a perpetual system records entries to the cost of goods sold every time it makes a sale. The periodic system calculates cost of goods sold. Obviously, the perpetual system is a more advantageous system. It's keeping more detailed records, more control over the inventory, much more so than a periodic system can. Question. A company determines the cost of goods sold each time a sale occurs in a perpetual inventory system only. All right, now we're learning about some new accounts here in Chapter 5 that some of them we've already talked about. Our sales revenue account, let me do a T account here, is going to have the same rules of debit and credit as any other revenue account. So these are going to be our rules for our sales account. Our cost of goods sold, we said, acts like an expense account. So it's going to increase on the debit, decrease on the credit. We've learned about a new asset account called inventory, and it's going to have the same rules of debit and credit as any other asset account. Here in a few moments, we're going to look at something called a contra revenue or a contra sales account. And one of them is called sales returns and allowances. And the other one is called sales discounts. These are going to be contra to our sales revenue account. Like we talked about accumulated depreciation being a contra asset account, our contra revenue accounts are going to be contra to the sales revenue account. So they're going to have the opposite rules of our revenue account. So they're going to increase on the debit, decrease on the credit, and so is our sales discounts. Okay, let's look at how our businesses will record our transactions related to our inventory. We're going to be looking at it from both the buyer's and the seller's perspective. We're assuming both of these businesses keep track of their inventory under the perpetual inventory system. PW Audio Supply is going to be our seller. Sauk Stereo is going to be our buyer. We're first going to look at our entries that are going to be made by the buyer, Sauk Stereo. So to Sauk Stereo, this would be a purchase invoice showing the items being purchased, what the credit terms are, we'll talk about that here in a minute, what the shipping terms are, we'll talk about what that means here in a moment, the total cost of what is being purchased. So this is a purchase invoice. From PW Audio Supply's perspective, which we'll look at momentarily, this is considered a sales invoice. All right, let's look at how Sauk Stereo, the buyer, will record the purchase of this merchandise inventory from PW Audio Supply. Again, we're assuming both of these businesses keep track of their inventory under the perpetual inventory system. So, Sauk Stereo, the buyer, will debit the inventory account by the total cost of this inventory that they're buying. And since they're buying it on account, we know that because there's credit terms shown here. Again, we'll talk about what this means in a minute. Sauk Stereo is going to pay for this at a later date, so we're going to credit accounts payable. Sauk Stereo now owes PW Audio Supply $3,800. A question. In a perpetual inventory system, which account would be debited when goods are purchased with the intent of being sold? Well, that's what we just looked at. That would be the inventory account would be debited. If you recall, on that purchase invoice, there were the shipping terms of FOB shipping point. Shipping terms designate who is going to pay the cost of shipping the goods, the freight costs. If the shipping terms are FOB shipping point, it means the buyer is going to pay the freight cost. If it's FOB destination, it means the seller is going to pay the freight costs. FOB stands for free on board. In Chapter 6, when we talk about inventory and when title to the inventory passes, we're going to talk about these same two terms, the FOB shipping point, FOB destination. FOB shipping point, legal title to the goods transferred to the buyer as soon as they leave the seller's place of business. But if it's FOB destination, the buyers are going to retain ownership, the seller is going to retain ownership in the goods until they reach the buyer's place of business. If the buyer is paying the freight cost, that increases the cost of the inventory. So we're going to record it into the inventory account under the perpetual system. If the seller has to pay the freight costs, this is just going to act as an operating expense to the seller. Another question. FOB shipping point meant that the buyer pays the freight. Okay, in this example we're looking at, assume that Sauk Stereo is paying the freight charges. This is the entry Sauk Stereo would make. It's going to debit the inventory account, $150, credit cash. If the seller, PW Audio Supply, is paying the freight charges, they're going to debit some type of expense, freight out or delivery expense, and credit cash. Think about it in these terms. If you order something online and it costs you $100 and you have to pay a $10 freight charge, what was the real cost to you of that thing that you ordered online? Well, it would be $110. So by debiting our inventory account here by the $150, the cost to Sauk Stereo of this inventory that they're buying has gone up by $150 because they're having to pay the freight charges. Now, let's look at purchase returns and allowances. A purchase return occurs when goods are sent back to the seller, either that's the wrong type, it does not meet the specifications of the order, there's some problem with it, or perhaps we never even ordered it. A purchase allowance is a reduction in price given to the buyer, but the buyer keeps the goods. An example of this would be, let's say you ordered a shirt online and you ordered a blue shirt and the seller accidentally sends you a red shirt, and you call the seller up after you receive this red shirt and you say, I ordered a blue shirt, you sent me a red shirt. Well, if the seller were to say to you, I tell you what, the price for this shirt was $50. If you'll keep that shirt, we'll knock $25 off the price. We'll only charge you $30. That $20 reduction in price would be called a purchase allowance. Again, then you would have to make the decision, okay, I'm not getting the exact color of shirt that I want, but hey, if I can get it for $20 off, I can live with a red shirt. That's how a purchase allowance would work. A purchase return and a purchase allowance will be recorded the exact same way in our accounting system. So in our illustration here, Sauk Stereo is returning goods that cost $300 to PW Audio Supply. We don't know why. They're defective, they weren't the right size, right style, whatever the reason. The entry to record the return of these goods would involve us debiting accounts payable, because now Sauk Stereo doesn't owe PW Audio Supply for those goods that they're returning, so we're reducing the amount that Sauk Stereo owes to PW Audio Supply. But we no longer have this inventory, so we have to remove that from our asset account inventory by crediting it. If there was some problem with the order and Sauk Stereo were to call PW Audio Supply and say, PW, you sent me these goods, it wasn't exactly what I ordered, and PW said to Sauk, I tell you what, if you'll keep these items, we'll knock $300 off the price if you'll keep them. Well, if Sauk Stereo agreed to that, then Sauk would make this exact same entry. So whether it's a purchase return or a purchase allowance, the same entry would be made. Another question. In a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting the inventory account. All right, let's talk about purchase discounts. If you will think back to the purchase invoice we looked at, there were some credit terms shown there that said 2/10, N/30. It looked just like this. When you read that, you basically read that as 210 net 30. This simply means that the seller is offering to the buyer a 2% discount if the buyer will pay within 10 days of the invoice. Otherwise, the full amounts due within 30 days. The advantage to the seller of offering these type of credit terms is that they will more than likely receive their cash payment from their customer more quickly, And the obvious advantage to the buyer is they can get a 2% discount by paying 20 days earlier than they normally would. So it would be a win-win for both the buyer and the seller. Here are some other examples. 210 net 30, it might be 115 net 45. You could think of a bunch of different variations. Sometimes you might see something that looks like this, but something that is styled like this is more normal than these other two. So back to our Sauk Stereo example. Sauk Stereo decides that it's going to pay the amount that it owes. Remember, they don't owe $3,800, they owe $3,500 because remember they returned $300 worth of goods. And they're going to pay it on May the 14th, which is the May the 14th, which is the last day of the discount period. So Sauk wants to take advantage of the 2% discount by paying within the 10 days. Of course, 2% of $3,500 is $70. So when Sauk pays the amount, they're going to pay the $3,500 less the $70, or $3,430. So they're going to write a check for $3,430, send it to PW Audio Supply. But when they record this entry, they're going to go in and debit accounts payable for $3,500. This credit to our inventory account by the amount of the discount is done because the cost of the inventory now has been reduced by this $70 discount. So decreasing the inventory balance is what needs to be done. Obviously, the reason we're going to debit accounts payable for the full amount that's owed is that if we didn't do that, if we went in there and debited accounts payable $3,430 and credited cash $3,430, it is still going to look like Sauk Stereo still owes PW Audio Supply $70. But after they pay this $3,430, Sauk Stereo does not owe them a dime. Of course, if Sauk Stereo paid it beyond the 10-day discount period, then they would pay the full amount, and this is the entry Sauk Stereo would make. This slide just demonstrates whether a discount should be taken if it's offered, and it certainly should, because just by paying it 20 days earlier, you can have a substantial return on your money. Now we're looking at fairly small dollars here, this $70, this 2% of $3,500. You can imagine if this was a $350,000 purchase, how 2% could really make a difference. This slide shows the summary of the transactions related to inventory that we just recorded. When we bought our inventory, we debited our inventory for the $3,800. When Sauk Stereo had to pay the freight charges, that increased the cost of that inventory by $150. Of course, on the 8th of this month of May, $300 worth of goods were returned. And then when Sauk Stereo paid within the discount period and took advantage of that 2% discount, it reduced the cost of that inventory by $70. So the total real cost of this inventory that was purchased by Sauk Stereo from PW Audio Supply was this $3,580. Okay, let's look at how a business who keeps track of their inventory under a perpetual system would record the sale of merchandise inventory. This, to PW Audio Supply, is considered to be a sales invoice. Again, it's going to show total amount of inventory that has been sold. Again, this is the same invoice that the purchaser received, and they consider it a purchase invoice. A perpetual inventory system will make two entries when it makes a sale of merchandise inventory. They will debit cash, or if it's a credit sale, accounts receivable, and they will credit sales revenue. And as we talked about earlier, a perpetual inventory system business records cost of goods sold with each sale. So there's going to be a debit to the cost of goods sold account and then a credit to the inventory account because the inventory balance has been reduced. So back to our sale of $3,800 worth of merchandise from PW Audio Supply, the seller, to Salk Stereo, the buyer. We are given that the merchandise cost PW Audio Supply $2,400. So when PW Audio Supply purchased this inventory from their supplier, it cost them $2,400. So PW is going to record a debit to accounts receivable. This is a credit sale, and a credit to the sales revenue account. Then a debit to cost of goods sold for the $2,400, and a credit to the inventory account, $2,400. Now, if you will remember, Salk Stereo returned some merchandise inventory to PW Audio Supply, $300 worth. From PW Audio Supply's perspective, that's considered to be a sales return. A sales return or a sales allowance, we talked about what a purchase allowance was. The sales allowance is the other side of the transaction, are considered to be contra revenue accounts. They end up reducing the amount of our real sales revenue. Okay, we're going to keep track of our sales returns allowances separately so that the business can manage its sales revenue account better and see are they having an unusual amount of sales returns and allowances. So they keep track of them separately. As you'll see here in a moment, we're going to combine the sales revenue account with our sales returns allowances and another contra revenue account we'll talk about in a minute, sales discounts, to come up with our actual sales total called net sales. So here's how PW Audio Supply would show the return of the merchandise that Salk Stereo sent back to them. And remember the amount of the return was $300. We have to know what the cost of that inventory was to PW Audio Supply. And here it shows that what that cost PW was $140. So to record the sale return, we're going to debit the sales returns and allowances account and credit the accounts receivable account, because now Salk Stereo no longer owes this $300 to PW Audio Supply. Then we've got to add the cost of that inventory back into the inventory account of PW Audio Supply and reduce the cost of goods sold, because now this inventory has no longer been sold. If the reason for the return was that the merchandise was defective, PW Audio Supply is going to record that back into their inventory at the value of the inventory. So if it was $50, then we're going to add $50 back in and credit inventory. We're going to debit inventory for the 50, credit cost of goods sold for the 50. This slide shows the T accounts for our sales revenue, our sales returns allowances, and our sales discounts. Remember, our revenue account is going to increase on the credit side, decrease on the debit side. Our contra revenue or our contra sales accounts are going to have the opposite rules of debit and credit. Sales returns and allowances is going to increase on the debit, decrease on the credit. And another contra revenue account, sales discounts. Remember, when Salk Stereo paid the balance that was owed less the 2% discount, that amount of that discount was $70. So our sales discount account has these rules of debit and credit: increase on the debit, decrease on the credit. So the real amount of the sales revenue is the $3,800 in sales minus the $300 in sales returns and allowances and minus the $70 discount. So the real amount of the sales, net sales, is $3,430. So here's how PW Audio Supply would record the receipt of the amount from Sauk Stereo. Remember, Sauk Stereo bought $3,800 worth of goods. They returned $300 worth of goods. So what Sauk owes to PW is $3,500. But remember, they took advantage, they paid within the discount period, so took advantage of the $70 discount, the 2% of the $3,500, not 2% of the $3,800. Got to be careful with that. This is how PW would record that transaction. Remember, Sauk Stereo paid PW $3,430, so PW is going to debit cash for the $3,430, debit sales discounts, that contra revenue account, for that $70, and then the credit is going to be to accounts receivable for the $3,500. If PW had gone in and debited cash for $3,430 and credited accounts receivable for $3,430, PW's books would look like that Sauk still owed them an additional $70, which we know is not the case because of this $70 discount. Now, our previous slides that we just looked at, we looked at perpetual inventory system businesses, and we looked at it from both the buyer's perspective, Sauk Stereo, and the seller's perspective, PW Audio Supply. We'll look at these same entries momentarily, but we'll assume both of them operate using a periodic inventory system. Now, let's talk about adjusting entries for our merchandise business. They're going to have the same types of adjusting entries that a service business would have. They're going to have their different prepaid expense adjusting entries, their different unearned revenues, their accrued revenues and accrued expenses. But one adjusting entry that a merchandising business is going to have that a service business will not will be to adjust inventory to actual. So at the end of the accounting period, the merchandising business will go and count their inventory. If you've ever participated in that through some type of job you might have, you know how much fun that can be. So you go and count the inventory, determine how much you have on hand, and then you're going to adjust your account balances to actual. So you're going to adjust your inventory account to the actual amount of inventory you truly have. The other side of that adjusting entry is going to be the cost of goods sold. Let's say PW Audio Supply goes in and they count their inventory and they find they actually have $40,000 worth of inventory on hand. When they look in their general ledger account for their merchandise inventory, they see that balance is $40,500. Okay, we don't necessarily know what occurred, what caused this difference. It could be there were clerical errors made in the inputting of the information into the accounting system. Could have been some inventory disappeared either out the front door, shoplifting, or out the back door, employee theft. Whatever the reason, this is the adjusting entry that PW Audio Supply would make. They're going to debit cost of goods sold for $500 and credit the inventory account $500. Again, that is going to adjust that inventory account balance from $40,500 down to $40,000, which is the actual amount of inventory that PW Audio Supply has counted. If this were reversed, if they counted $40,500 in inventory and their general ledger account balance was only $40,000, then this entry would reverse. We would go in and debit inventory for $500 and credit cost of goods sold $500. Okay, let's look at the closing entries for our merchandising business. They're going to look very similar to the closing entries we saw in our service business there in Chapter 4. Our first closing entry will be to close our revenue accounts to income summary. Notice it doesn't say revenue accounts, it says income statement accounts with credit balances. When we look at a periodic inventory system business in a minute, we're going to be looking at some different accounts, and some of those accounts are going to have credit balances. They're not revenue accounts. They're called contra purchases accounts. So our description of our closing entry is going to change. We're going to say to close income statement accounts with credit balances. Our second closing entry will be to close income statement accounts with debit balance. Remember, under our service business, we said to close our income statement accounts. But now we have two contra revenue accounts that we're also closing, which are not expense accounts. So again, it adjusts our description for this second closing entry. We also have cost of goods sold that we're going to close. Again, cost of goods sold is not considered to be an expense account. It's called a cost of merchandise account, but it acts like an expense. And of course, we have all of our other expenses we're closing. So we close our income statement accounts with credit balances here. That's going to close all of those income statement accounts to zero and transfer that to our income summary account. Then we're going to close all of our income statement accounts with debit balances here. That's going to close all of those accounts to zero, and we will have transferred the balance in those accounts to the debit side of our income summary account. That's going to leave us with a credit balance in our income summary account of $30,000 because we've credited it for $480,000, we've debited it for $450,000. So our third closing entry is to close our net income, which that's what that amount is, to retained earnings by debiting income summary $30,000, crediting our retained earnings account. Remember, that increases the retained earnings, which is the effect net income has on retained earnings. So after this third closing entry, now our income summary account balance is zero, and we have transferred that net income to retained earnings. Last closing entry, we're going to close dividends to retained earnings, just like we talked about in Chapter 4, by debiting the retained earnings account, crediting the dividends account. Okay, Chapter 5 talks about two types of income statements, a single-step income statement and a multiple-step income statement. I've never seen a single-step income statement out there in the real world, so we're just going to look at the multiple-step income statement. What our multiple-step income statement is going to do, it's going to break down our revenues and expenses between our operating activities and our non-operating activities. Operating activities are going to be those activities that the business does in its normal course of business. Non-operating activities are going to be something that comes up that's more unusual. It's not part of our normal operations. For instance, if we sell some equipment and we record a gain or a loss on that sale of that equipment, which we'll talk about in more detail in Chapter 9, but we're not in the business of selling equipment, so that non-operating activity is going to be separated out within our multiple-step income statement. Let's look at it. Here is our multiple-step income for PW Audio Supply. You'll see that the different sections are shown here of our multiple-step income statement. We have our sales revenue account balance. We're going to subtract from that our two contra revenue accounts, sales returns and allowances and sales discounts. Those two total up to $20,000. We subtract that from our sales revenue to get our net sales. From our net sales, we subtract our cost of goods sold, and that gives us our gross profit of $144,000. We then subtract our operating expenses, just like we saw in our service business. This is our total operating expenses. Subtracting our total operating expenses from our gross profit gives us our income from our operations, or income from our normal operations. If we have any non-operating activities, in this example we have a couple. We have other revenue and gain of interest revenue and a gain on a sale of some plant assets. Those total up to $3,600. And we have two non-operating expenses and losses. We have interest expense and a casualty loss from vandalism. Somebody threw a rock through one of our windows or whatever that might have occurred. Those two total up to $2,000. So we take our income from our operations, we add our other revenues and gains, subtract our other expenses and losses to get this net income amount of $31,600. Here are some other examples of other revenues and gains and other expenses and losses. Again, these are not part of the normal operations of the business, so we separate them out. This allows the users of our financial statements, as they're looking at our income statement, to see, yes, we can see what their final net income was, but what do we expect to occur in future accounting periods based upon what their normal operations are, not these somewhat more unusual items. Okay, here is our final income statement. Again, let's review it. We have our calculation of our net sales, subtracting our contra sales from our sales revenue to get net sales. From that, we subtract our cost of goods sold to give us our gross profit. Then we subtract our operating expenses to get income from operations. We add any other gains and losses, subtract any other expenses and losses to give us our final net income determination. Here is a partial balance sheet for PW Audio Supply. It shows our inventory as part of our current assets. We expect to sell our inventory and convert that to cash within a 12-month time period or operating cycle, whichever is longer. And since most businesses have an operating cycle of less than 1 year, again, typically we're going to look at that 12-month period. We're going to include inventory right below our accounts receivable because we're going to collect those receivables and convert those to cash before we get this inventory sold, which is probably going to go to a receivable before it becomes cash. Okay, this slide comes from Appendix 5A. Looking at a worksheet for our merchandising business is going to look just like our worksheet for our service business, except we have some different accounts here. We had this different adjusting entry where we adjusted our inventory to our cost of goods sold, giving us this closing inventory balance of $40,000. Of course, that inventory account is an asset, so it's going to belong under our balance sheet section of our worksheet. And then all of our income statement accounts are going to be included in our income statement section of our worksheet. So we have our sales revenue, we have these two contra sales accounts, and of course our cost of goods sold. And again, the bottom portion of our worksheet functions just like our worksheet for our service business. Now let's talk about a periodic inventory system. When I took this course many years ago, our focus was on the use of the periodic inventory system because most businesses could not afford the technology to keep detailed track of their inventory. It just wasn't feasible for them to do so. In today's marketplace, even your smaller businesses can afford the technology to keep track of their inventory in detail. So it's kind of reversed over the last 35-40 years. Okay, remember, a periodic inventory system does not keep track of its inventory in detail. It's going to count its inventory at the end of the year and calculate cost of goods sold on the income statement. And this is how that's going to look under a periodic system. We'll talk about these accounts specifically here in a moment when we look at the journal entries, but this is the calculation of cost of goods sold. We looked at this same formula back early part of this chapter where we looked at our flow of cost for a merchandising business. We said we took our beginning inventory, we added to that the cost of our merchandise that we purchased, and that gives us what we have available to sell. If we sell it, those costs go to cost of goods sold. If we don't sell it, we still have that inventory. That's going to be our ending inventory balance. So we calculate cost of goods sold on the income statement under a periodic inventory system. We'll talk in a minute how to calculate the total cost of our merchandise purchase. We're going to be using some different accounts. We use the inventory account under a perpetual inventory system. We're going to use an account called purchases. We'll talk about that in a minute. We're going to use two accounts that are called contra purchases accounts, purchase returns, allowances, purchase discounts. And then we're going to use an account called freight in. Under a perpetual system, we use the inventory account. Under a periodic system, we're going to use the purchases account, the purchase returns allowances account, the purchase discounts account, and the freight in account. Let's look at the rules of debit and credit for some of these new accounts we're going to be talking about. First account we're going to be looking at is the purchases account. I'm going to abbreviate here. But the rules of debit and credit for our purchase account is going to be to increase on the debit, decrease on the credit. The freight in account, I'm going to abbreviate here to FI. Sometimes this is called transportation in, TI. They are used interchangeably. The rules of debit and credit for our freight in account is going to be the same as our purchases account. Increase on the debit, decrease on the credit. Now our two contra purchases accounts are purchase returns and allowances and our purchase discounts are going to have opposite rules of debit and credit that our purchases account has. So they're going to decrease on the debit, increase on the credit, both of these. We'll talk about how these are used now as we look at the entries that would be recorded. Okay, let's look at how we're going to make our entries into our accounting records. Our periodic inventory system business is going to use this purchases account when it buys merchandise inventory. If there is a return or allowance or a purchase discount, we're going to use the purchase returns and allowances account and the purchase discounts account. If the buyer has to pay the freight, we're going to use an account called freight in. Again, under the perpetual system, for each of these types of transactions, we use the actual inventory account. Another difference about the periodic inventory system business is it does not record cost of goods sold with each sale. It calculates cost of goods sold on the income statement. Okay, let's look at the same entries that we looked at for the buyer, Sauk Stereo, assuming they record their entries using a periodic inventory system. And then we're going to look at the sales transactions that PW Audio Supply would make, assuming they also use a periodic inventory system. These are going to be the identical transactions we looked at a few slides back under the perpetual system. So when Sauk Stereo buys $3,800 worth of inventory, it's going to debit the purchases account and credit accounts payable. Remember, under the perpetual system, we debited the inventory account. Not so under the periodic system. When the buyer pays the freight charges, so if Sauk pays for the freight charges, whatever it takes to get it from the seller's place of business to the buyer's place of business, Sauk Stereo is going to debit freight in, or as I said earlier, sometimes it's referred to as transportation in, for that $150, and they're going to credit cash. Remember, under the perpetual system, we debited the inventory account. Okay, let's show how the return of the $300 worth of merchandise inventory to PW Audio Supply would be recorded by Sauk Stereo. Sauk is going to debit accounts payable for $300 and credit purchase returns and allowances $300. Remember, under the perpetual system, there was a credit to the inventory account of $300. And then the payment of the amount owed less the 2% discount under the periodic system, we're going to debit accounts payable for $3,500 just like we did under the perpetual system. Instead of crediting the inventory account for $70, we're going to credit purchase discounts for $70. Of course, our other credit to cash is the same, $3,430. Okay, here's a question. In a periodic inventory system, a return of defective merchandise by a purchaser is recorded by crediting purchase returns and allowances. Remember, we credited the inventory account under the perpetual system. Now let's turn our attention to PW Audio Supply, the seller. Again, we're going to change it now to where PW Audio Supply keeps track of its inventory under a periodic inventory system. So, PW Audio Supply is going to record the sale, just like we recorded under the perpetual system. Debit accounts receivable, credit sales revenue for $3,800. But we're not going to make that debit to cost of goods sold and credit to the inventory account like we did under the perpetual system. The return of merchandise. We're going to go in and debit sales returns and allowances for $300, credit accounts receivable for $300, just like we did under the perpetual system. But once again, we're not going to make an entry debiting inventory, crediting cost of goods sold like we did under the perpetual system. And then finally, when PW Audio Supply receives full payment that's owed less the 2% discount, PW is going to debit cash for the $3,430, debit sales discounts for the $70, credit accounts receivable for the $3,500. This is identical to how we recorded it under the perpetual system. So there's no difference when a payment is received by the seller. Now let's look at a side-by-side comparison of the entries we would make from the buyer's perspective. We'll look at both the perpetual inventory system and the periodic inventory system. My recommendation to you will be as you work problems, that you keep this available to help you know what accounts to be debited and credited. And again, over time, you'll have to refer back to it less and less. So, when we buy merchandise and inventory under the perpetual system, we debit the inventory account. Under the periodic system, we debit the purchases account. When the buyer pays the freight charges, the perpetual system debits inventory. The periodic system debits freight in, or transportation in, as we saw earlier. If there's a return or allowance, we're going to go in and debit accounts payable and credit the inventory account under the perpetual system. Under the periodic system, we're still going to debit accounts payable, but we're going to credit the purchase returns and allowances account. And then finally, payment with the discount, still going to debit accounts payable for $3,500 and credit cash for the $3,430, but our perpetual system is going to credit the inventory account for the amount of this discount. Under the periodic system, we're going to credit purchase discounts for the $70. And then from the seller's perspective, PW Audio Supply, when there's a sale of merchandise inventory on credit, both systems are going to record the sale exactly the same, but the perpetual system is going to record a debit to cost of goods sold and a credit to inventory that the periodic system does not. And then if there's a return of merchandise or if there's an allowance granted, both parties are going to both debit sales returns, allowances, and credit accounts receivable, but the perpetual system is going to add that inventory back to their inventory account, and they're going to credit cost of goods sold that the periodic system does not. And then, of course, when the cash is received on account with a discount, both parties record that entry exactly the same. This slide shows our worksheet for a business that keeps track of its inventory under the periodic inventory system. This is how we're going to make our adjustment to our inventory account. Again, we're going to have sales revenue and sales returns, allowances, sales discounts on our income statement section of our worksheet. But again, the periodic system is going to close their purchases account, their two contra purchases account, purchase returns, allowances, and purchase discounts, and they're going to close their freight in account. All these will be included under the income statement section of our worksheet. And again, this worksheet is going to function very similarly to our perpetual inventory system, and then also as we looked at under our service business. That concludes Chapter 5 on merchandise businesses.